Every bull market in crypto is driven by hype cycles and dominant narratives. In 2017, it was ICOs, and in 2021, it was DeFi and NFTs. Now, in this cycle, we're seeing a whole new wave of narratives that are shaping where money is flowing and what's getting the most attention. But not all narratives are created equal. Some will have lasting impact and shape the future of crypto for years to come, while others are purely speculative and will fade away once the hype dies down. If you don't know how to separate real innovation from temporary mania, you could end up holding the wrong assets at the wrong time. Today, we're going to break down the biggest crypto narratives of this bull run, why they're gaining traction, and how to navigate these trends without falling for the hype. First, let's talk about why narratives are so important in crypto. Unlike traditional markets where valuation models and earnings reports drive investor decisions, crypto is still largely fueled by speculation and emerging technologies. The most successful projects aren't always the most fundamentally sound. They're often the ones that capture the biggest narratives at the right time. We've seen this play out again in every cycle. In 2017, ICOs dominated the market with projects raising billions of dollars just by issuing tokens or publishing a really simple white paper, regardless of whether they had a working product or not. In 2021, the NFT boom created millionaires overnight, and everyone rushed to buy profile pictures and digital art. Did anyone ever get that pet rock or the paperclip? Each of these trends created massive opportunities for early investors, but they also led to bubbles that eventually popped. The key is understanding which narratives have real staying power and which ones are purely speculative. So what's driving the hype this cycle? Let's start with one of the biggest narratives: artificial intelligence and crypto. AI has been one of the fastest growing industries in tech, and now it's merging with blockchain in ways that are capturing investor attention. AI-powered trading bots, decentralized AI networks, and data marketplaces are all part of this trend. The idea is that blockchain can provide a decentralized infrastructure for AI, preventing monopolies from controlling access to powerful machine learning models. But here's the question: how much of this is real and how much is just marketing hype? Some AI tokens have already skyrocketed in value, but the actual utility of these projects is still unproven. AI is a legitimate technological revolution, but not every AI-related crypto project will succeed. Another major narrative in this cycle is real-world assets, or tokenized RWA. This is the idea that traditional financial assets like stocks, bonds, real estate, and commodities can be brought onto the blockchain as digital tokens. Institutional investors are especially interested in this space because it creates liquidity for previously illiquid assets and enables instant global transactions. We're seeing major financial firms exploring tokenized treasury bonds, real estate investment platforms, and even commodities like gold being issued on blockchain networks. This is a narrative that has real long-term potential. Unlike meme coins and speculative altcoins, real-world assets, RWAs, represent a bridge between crypto and traditional finance, which is why this trend is gaining traction among serious investors. Next, let's talk about Layer 2 scaling solutions. Ethereum has long struggled with high transaction fees and network congestion, which is why Layer 2 solutions like Arbitrum, Optimism, and zk Sync have exploded in popularity. These networks allow users to transact faster and cheaper while still benefiting from Ethereum's security. Now, this is one of the strongest narratives in the current cycle because it solves a real problem. Every time Ethereum gas fees spike, users look for alternatives. Layer 2s are providing that solution. They're also attracting developers to build new applications on top of them. One of the biggest trends happening within this space is the rise of airdrop speculation. Users are farming Layer 2 protocols, hoping to qualify for token airdrops, similar to what we saw with Uniswap and Arbitrum in previous cycles. This has driven huge engagement on these platforms, but it also raises the very important question of whether the hype will fade once the airdrops are actually distributed. Another major trend in this bull run is the evolution of decentralized finance, or DeFi 2.0. The first wave of DeFi brought lending protocols, decentralized exchanges, and automated market makers. But many of these projects struggled with sustainability, leading to liquidity crisis and exploit vulnerabilities. Now we're seeing new DeFi models focused on real yield, better risk management, and deeper institutional adoption. Liquid staking protocols, decentralized derivatives, and fixed income DeFi products are all growing in popularity. Now, the key to playing this narrative is identifying which projects are actually innovating versus those that are simply repackaging old ideas. Many DeFi tokens from previous cycles never recovered because they were based on unsustainable Ponzi-like incentives. The strongest projects moving forward will be the ones that can attract long-term users and institutional liquidity. And of course, we can't talk about crypto narratives without mentioning meme coins. Meme coins have been a dominant force in every bull run. Yes, Dogecoin, Shiba Inu, and now newer meme coins are capturing attention once again. Unlike other sectors of crypto, meme coins aren't driven by fundamentals whatsoever. That's kind of like the defining thing of a meme coin. They have no fundamentals. They're entirely based on community hype and viral marketing. While some meme coins generate massive gains, they also experience some of the worst crashes. Now, the key to playing this trend is understanding that meme coins are not investments, they are speculative trades. If you're going to participate, you need to have a clear exit plan and recognize that these tokens can drop 90% overnight once the hype fades. So, how should investors navigate these narratives without getting caught up in the hype? The first rule is to identify whether a narrative has real staying power. Ask yourself, does this solve an actual problem or is it just speculation? Layer 2 solutions and real-world assets have long-term potential. Meme coins and AI tokens, some might succeed, but many will disappear once the hype is gone. The second rule is to time your entry and exits. Narratives follow a predictable pattern. They start with early believers, they explode as hype grows, and then they collapse when liquidity dries up. If you're investing in a narrative after everyone is already talking about it, you're probably late. The biggest gains are made by those who identify trends early and exit before the bubble pops. The third rule is to diversify. Don't put all your money into one narrative. Bull markets are unpredictable, and while some narratives will dominate, others might fade faster than expected. Having exposure to multiple sectors ensures that you don't get stuck in the wrong place when the cycle shifts. And the final rule is to take profits. No matter how strong a narrative seems, nothing in crypto goes up forever. You hear me? If you're sitting on major gains, don't be afraid to take some off the table. People who make life-changing money in crypto are the ones who know when to walk away with profits instead of getting greedy. So I'm curious, what do you think? Which narrative is the most important in this cycle? Are you focusing on AI, real-world assets, DeFi, or layer 2s? Let me know in the comments. And if you want to learn more about how to navigate crypto without getting caught up in the hype, check out learningcrypto.com. It's the best place to get real, practical crypto education. Thanks for watching. I'll see you in the next one.